Picture a world where the money in your digital wallet is as steady as the bills in your pocket, yet moves with the speed and freedom of a text message, leaping across borders and time zones in the blink of an eye. Imagine making a payment to a friend halfway around the globe, buying groceries from your favorite app, or sending funds home to your family, without ever worrying about wild price swings or days-long delays. That world, once a distant dream reserved for science fiction, is suddenly within reach. But the final leap is more unpredictable than ever, thanks to a seismic decision in Washington that has sent shockwaves through the financial world. On the 18th of June 2025, the United States Senate passed a piece of legislation that could become the most consequential financial law of the 21st century, the Genius Act. This groundbreaking bill is designed to bring long-awaited order to the chaotic universe of stablecoins, digital currencies meant to combine the best features of traditional money and cutting-edge technology. For some, this is a bold new dawn for American financial leadership and innovation. For others, it is a high-stakes gamble that could reshape or even destabilize the future of money itself. As the debate erupts, every corner of the financial world, regulators, banks, tech giants, and ordinary people are watching, wondering what's at stake and why it matters to everyone. Let's rewind for a moment to understand how we got here. Cryptocurrencies like Bitcoin and Ethereum burst onto the scene with promises to revolutionize money, to liberate finance from the constraints of banks and governments. But their notorious price swings, sometimes soaring or crashing by double-digit percentages in a single day, have left most people and businesses on the sidelines, wary of betting their savings or livelihoods on such unpredictable assets. Enter stablecoins, digital tokens that are, in theory, pegged to reliable assets, most often the venerable United States dollar. Stablecoins such as Tether, USD Coin, and Paxos Standard aim to function as digital cash, maintaining a steady value, providing a safe store of wealth, and enabling seamless transactions. The scale is already staggering. In the past year alone, global stablecoin transactions soared past $28 trillion, outpacing the combined annual volumes of MasterCard and Visa. For millions living in countries grappling with hyperinflation or volatile local currencies, stablecoins have become much more than a novelty. They are a financial lifeline, an escape hatch from economic chaos and excessive banking fees. But behind the scenes, stablecoins are only as trustworthy as the systems that back them. In May of 2022, the world watched in disbelief as Terra USD, an algorithmic stablecoin from Terraform Labs, collapsed almost overnight. Unlike conventional stablecoins, Terra USD was not backed by real-world dollars or cash equivalents, but instead relied on a complex algorithm and market incentives. When confidence faltered, billions in value were wiped out in days, erasing individual savings and unleashing panic across the crypto ecosystem. The fallout was immense. Families lost their nest eggs, businesses folded, and the broader crypto market suffered a historic loss of trust. That disaster became a clarion call for stricter regulation. Lawmakers, regulators, and financial experts warned that without clear rules and robust oversight, the next failure could be even bigger, potentially threatening not just crypto enthusiasts, but the wider financial system. The collapse of Terra USD was compared by some analysts to the infamous Lehman Brothers bankruptcy during the 2008 financial crisis, highlighting the risks of unregulated financial innovation. Fast forward to today, and the Genius Act arrives with sweeping promises to restore order and confidence. The law requires that every stablecoin issued in the United States be fully backed at all times by safe, liquid assets. Think cash on hand, short-term United States Treasury bills, or insured bank deposits, assets that can be quickly converted to dollars if needed. The era of risky algorithms and creative accounting is, for now, being put to rest. Monthly independent audits by reputable accounting firms become mandatory, and company executives, think CEOs and CFOs, must personally attest to the accuracy of reserve reports, putting their professional reputations on the line. The act gives banking regulators sweeping powers to supervise issuers, aiming to prevent another Terra USD-style catastrophe and to protect consumers, investors, and the broader economy. Senator Tim Scott, chair of the Senate Banking Committee, heralded the passage of the bill as a bold step forward for financial innovation, American leadership, consumer protection, and economic opportunity. On the other side of Congress, French Hill, a leading voice in the House of Representatives, echoed this optimism, saying, Clear rules of the road for stablecoins are long overdue, and we're one step closer to creating a functional regulatory framework that works for everyone. But beneath the celebrations, fierce controversy is brewing. Not everyone is convinced that more regulation equals greater safety. Senator Elizabeth Warren, known for her tough stance on Wall Street and consumer protection, issued a stark warning. A bill that turbocharges the stablecoin market while facilitating the president's corruption and undermining national security, financial stability, and consumer protection is worse than no bill at all. Bartlett Naylor, an advocate at Public Citizen, argued that lawmakers had missed a historic chance to confront, in his words, the most flagrant corruption in presidential history, a reference to former President Trump's $57 million windfall from crypto token sales in 2024, tied to World Liberty Financial. The tension is not just political, it's economic and technological. Major banks, including Bank of America, Wells Fargo, and Citigroup, are racing to develop their own stablecoins. The stakes are enormous. Whoever controls the digital dollar could shape not just the future of American payments, but the global flow of money. In an era where digital wallets are as common as debit cards, control over the rails of digital value has become a new battleground. Tech giants and fintech startups are also entering the fray, experimenting with their own coins and payment networks. Meanwhile, the United States is not alone in this race. Across the Atlantic, Hong Kong's new Stablecoins Ordinance, taking effect on the 1st of August 2025, establishes a strict licensing regime for stablecoin issuers. The law requires full reserve backing and prioritizes fiat-pegged digital coins, aiming to reassure users and attract international business. In Europe, Deutsche Bank, a financial titan, has applied for an e-money license to launch its own stablecoin, hoping to carve out a slice of this multi-trillion-dollar market. In Asia, Singapore and Dubai have built reputations as innovation-friendly financial hubs, luring blockchain startups and capital from around the globe. The message is clear. The race to define the future of money is truly global, and the United States risks falling behind if it moves too slowly or fails to get the rules right. The Genius Act sets the stage for a fierce contest, not just between lawmakers and Congress, but among nations, banks, and technology juggernauts. Yet the law's future remains uncertain. The bill now moves to the House of Representatives, where an alternative proposal, the Stable Act, is making its way forward. The House bill takes a very different approach. Rather than centralizing oversight, it divides regulatory authority among the Federal Reserve, the Office of the Comptroller of the Currency, and other agencies. The Stable Act also bans stablecoin issuers from paying interest or yield to holders, aiming to prevent riskier bank-like behavior and avoid bubbles reminiscent of the savings and loan crisis in the 1980s. Some lawmakers suggest merging the two bills through a reconciliation process, but the debates are heated, and the outcome is far from certain. The legislative showdown is about more than just policy details. It is about who gets to write the rules for the digital money era. Should federal regulators in Washington hold the reins? Should states retain oversight, especially for smaller players? Or should there be a blend, allowing for both innovation and accountability? The Genius Act, for example, allows stablecoin issuers with less than $10 billion in market capitalization to choose state-level regulation. This provision was included after heavy lobbying by the Conference of State Bank Supervisors, which has long warned against unchecked federal expansion and the potential sidelining of state oversight. Brandon Milhorn, a spokesperson for the state supervisors, cautioned, CSBS remains concerned with the dramatic and unsupported expansion of the authority of uninsured banks to conduct money transmission or custody activities nationwide without the approval or oversight of host state supervisors. The tug-of-war between state and federal power is as old as the republic itself, and now it plays out in the digital realm. For ordinary consumers, these debates may seem abstract, but the outcome could change daily life in profound ways. Imagine paying for groceries, streaming services, or even your monthly rent with a regulated digital dollar-backed coin, enjoying lower fees and nearly instant settlement. For immigrants and global workers, sending money home could become faster, cheaper, and more reliable, bypassing expensive remittance services that collectively siphon off billions each year. Small businesses could gain access to more affordable and efficient payments, leveling the playing field against giant corporations. And as digital finance becomes more accessible, millions who are currently excluded from traditional banking could join the global economy for the first time. But the risks are very real. If Congress fails to reach agreement, the United States could end up with a patchwork of conflicting, confusing rules, creating uncertainty for businesses and consumers and making compliance a nightmare. Worse, this could drive American crypto innovators overseas, to places like Hong Kong, Singapore, or Dubai, where regulators have already established clear, innovation-friendly frameworks. Brett McLean of Kraken, a leading crypto exchange, observed, "Everybody's jumping into stablecoins right now. All the big banks, they're talking about creating their own. Others want to leverage existing ones. The competition is heating up, and the clock is ticking." There are also concerns about financial stability. Stablecoins, if not properly regulated, could become a source of systemic risk. Imagine a scenario where a large stablecoin issuer faces a crisis and must rapidly unload billions of dollars in assets to meet redemptions. That sudden sell-off could ripple through the financial markets, echoing the panic of the 2008 financial crisis, when fire sales of mortgage-backed securities triggered a global recession. The Genius Act seeks to prevent this by mandating full reserves and regular audits, but some experts worry that regulatory loopholes could still be exploited, especially by offshore or unlicensed actors. On the flip side, if regulation is too strict, fragmented, or slow to adapt, the United States could lose its edge in the digital economy. Already, other countries are moving quickly to claim leadership. The Financial Stability Board, a global body whose recommendations influence policy worldwide, has warned that a fragmented regulatory landscape could lead to regulatory arbitrage, where companies simply shop for the most favorable rules, undermining the effectiveness of oversight and consumer protections. The Genius Act also imposes tough anti-money laundering and sanctions compliance requirements on stablecoin issuers. Every issuer must implement robust programs to prevent illicit finance, terrorist funding, and sanction evasion, bringing stablecoins closer to the compliance standards of traditional banks. For users, this could mean more thorough identity checks, but also greater trust that digital dollars are secure and above board. It's a delicate balance. Too little oversight, and criminals could exploit the system. Too much, and innovation could stall, or privacy could be eroded. Investors and entrepreneurs are watching the unfolding drama closely. The new rules could level the playing field for compliant firms, opening the door to trillions in new investment, innovation, and jobs. Those who move quickly to meet the standards, by auditing reserves, disclosing operations, and implementing strong compliance programs, could gain a first-mover advantage in a market that is only set to grow. But those hoping to cut corners or exploit regulatory gray zones could face harsh penalties or be forced out altogether. For ordinary Americans, the stakes are no less important. As digital payments become the norm and the very definition of money evolves, the passage of the Genius Act could mark the beginning of a new era, where digital dollars are as trusted and familiar as paper ones. Yet, the speed of change brings its own risks. If lawmakers move too quickly or leave dangerous gaps, confusion and fraud could proliferate. Consumers will need to stay informed, seek out transparent and compliant stablecoin providers, and be wary of unregulated offerings that promise high returns or secrecy. Looking ahead, several possible scenarios could unfold. In the most optimistic vision, stablecoins become seamlessly integrated into mainstream payment systems, reducing costs and expanding financial access for millions. Retailers could start accepting regulated stablecoins at checkout, making digital payments as easy as swiping a card. Banks might offer accounts denominated in digital dollars, enabling instant transfers, new savings products, and even programmable payments that automate bills or investments. Governments could use stablecoins to distribute benefits more efficiently or to collect taxes in real time, potentially transforming how public services are funded and delivered. Alternatively, if the United States fails to set clear, cohesive rules, the digital currency landscape could fracture into competing jurisdictions, each imposing its own standards. That could lead to confusion, higher costs, and a loss of American influence in global finance. Or, in a more pessimistic scenario, a major stablecoin failure could erode public trust in digital money altogether, setting back adoption for years and handing the competitive advantage to rivals overseas. Expert opinions on these possibilities remain sharply divided. Senator Cynthia Lummis, a key architect of the legislation, confessed, "It has been extremely difficult. I had no idea how hard this was going to be." Andrew Olmham of Mayor Brown underscored the stakes, noting, "It establishes, for the first time, a regulatory regime for stablecoins, a rapidly developing financial product and industry." The debate is not just about technicalities, It is about the future of American prosperity, financial stability, and the role of the dollar in a rapidly digitizing world. If Congress finds common ground and passes a robust, thoughtful framework, the United States could set the gold standard for digital currency, attracting billions in investment and reinforcing the dollar's dominance for decades to come. But if lawmakers fail, the nation risks falling behind as others seize the initiative. Here's something most people don't realize. While Capitol Hill debates the fine print, some of the world's biggest banks and technology firms are already quietly building their own stablecoins, preparing for a future where regulated digital money is as common as debit cards or online banking. The real race is on, not just among countries, but among financial institutions, tech giants, and governments, all vying to define the next chapter of money. So, what does all this mean for you? In the coming years, the choices Congress makes on stablecoins will shape how you pay, save, invest, and move money. Will new rules turn stablecoins into safe, everyday money that everyone can trust? Or could they unleash risks and scandals nobody can control? The next act of the digital money revolution is being written right now, and every American, from Wall Street to Main Street, will feel its impact. As we stand on the brink of this new era, it's worth remembering that every great leap in financial technology, whether it was the invention of paper money in ancient China, the rise of central banks in the 18th century, or the creation of credit cards in the 20th, sparked intense debate, uncertainty, and opportunity. The story of stablecoins is only the latest chapter in this ongoing saga. What's your perspective? Should stablecoins be tightly regulated to protect stability and consumers, or should innovation have more room to flourish? Will America lead, or will it fall behind as others surge ahead? Join the conversation in the comments below, and don't forget to subscribe for more in-depth analysis at the frontiers of global finance and technology.